Shimatek's printing press in Lagos has plenty of orders to keep its workers busy, but its general manager, Everemadu Ihamadu, says rising energy costs are making their business unprofitable.
Yeah, it has affected the cost of production. Well, before now, if you are here at this press, here, Shimatek's press, before now we spend like close to 200,000 every month on NEPA card. With this new tariff, we're spending close to 300 or more. So it has really affected the cost of production.
Nigeria's government relies on crude oil exports for revenue. It spends these earnings on subsidizing fuel and electricity for domestic consumers and businesses. But international oil prices are down by around 40% this year, squeezing the government's budget. It's responded by raising taxes and rolling back subsidies. The International Energy Agency sees tougher days ahead for oil exporters. It expects global oil demand to fall by 8.4 million barrels per day, worse than its previous forecast of an 8.1 million barrel per day drop in August. That would drive worldwide oil sales down to 91.7 million barrels per day this year, compared to more than 100 million in 2019. And the IEA says a resurgence in COVID-19 cases will hinder growth in global demand. Analysts say major oil exporters may have to keep prices low to maintain market share in coming months.
The oil's been under pressure since the official selling prices from Saudi Aramco were dropped to Asia, and that's the first sign that things aren't going too well in the markets. Compounding the fact that we're ending the peak driving season in the U.S. and refinery run rates are going to fall as refinery maintenance period takes over. So there's a lot of negativity in the oil markets.
The strain on finances could force Nigeria's government to raise domestic energy prices even higher. If that happens, the writing may be on the wall for businesses like Shimatek's Printing. Mobin Nasir, TRT World.
Well, Neil Atkinson is the head of the Oil Industry and Markets Division at the International Energy Agency. He joins us now from Paris. Welcome to the program, Neil. Now, the IEA has cut its outlook for global oil demand for the second consecutive month. You now say the outlook for the oil market appears even more fragile than just a month before. Is that mainly because of the resurgence in coronavirus cases that we're seeing in several parts of the world?
Well, there are two sides to the balance. Clearly, the resurgence of COVID-19 cases in various parts is important, not least here, of course, here in Europe. So that is having an impact, and we think COVID-19 will have a longer impact than we perhaps thought a couple of months ago. But the other side of the balance, of course, is production. And although the OPEC Plus countries agreed to cut their production earlier this year, they have instigated a planned increase in their output quotas from August onwards. So at the moment, we're seeing a weakening demand outlook. Demand is still recovering, but not as strongly as we first thought. And at the same time, there is still plenty of supply out there. And of course, stocks remain very high indeed. And as finally, the previous Citicorp analyst who was speaking referred to reduced refiner demand for crude oil in the United States, and also, of course, in China. So it's a weaker outlook.
I want to come to what OPEC Plus might do just in a moment, but we know there was a lot of hope that demand would sharply recover as countries emerged from weeks and months of lockdown. We know that hasn't happened. Why is that? Was it a case of perhaps analysts were too optimistic about how quickly demand would recover after these lockdowns?
Well, demand did actually recover very quickly as an initial reaction to the lifting of the lockdowns. You can see a very clear V-shape in the demand curve. However, what has become apparent is that as we've moved out of the national lockdowns and people have started moving around again, living more normally, gone away for the holiday season, we started to see a resurgence of cases. And I think a point that needs to be made about anybody that's analyzing this market in the COVID world is that we're in a world we've never seen before. We're learning as we go along because the impact of this pandemic is very unpredictable. So it's a question of the COVID-19 is likely to be with us for longer than we had perhaps earlier estimated.
Now, you mentioned the OPEC Plus group easing some of their historic production cuts. We know that the group is due to meet later this week. Do you think they should actually revisit some of those curbs in production?
Well, that's a matter for them to decide as they take a look at their own market analysis. They meet on a monthly basis, a special subcommittee that's been set up to monitor the market, and they will make any adjustments to their production quotas as they see fit. But we shouldn't forget or fail to give credit for the fact that the OPEC Plus agreement that was signed in April, took effect in May, was an incredible achievement to bring together so many producers. And it's inevitable, as we have said earlier on in this interview, that with the COVID situation developing in a very unpredictable way, it may well be that they have a look again at how much supply is available to the market, and they may take some decisions to change the volumes. But we're not recommending that. We're not saying it's what they should do. That's probably something that they will at least be giving thought to.
As you say, those historic production cuts they agreed on in April was quite unprecedented and perhaps welcome given these unprecedented circumstances. But do you believe that the countries were largely complying with those cuts?
Well, we think that on average, since May, when the OPEC Plus agreement took effect, compliance by all the parties to the agreement has averaged out at 94%. Which, considering the history of various output cut agreements over the last 35 to 40 years, it's actually pretty good. But some countries are more compliant than others. That is certainly true this time around. It's always been true. But there is a mechanism within the agreement where producers who produce perhaps rather more than their quota currently allows can compensate for that by cutting back in due course, so that on average they're compliant. So 94% overall compliance by all the countries, that's actually pretty good.
Okay, Neil Atkinson, we'll have to leave it there, but thank you again for joining us from the IEA in Paris.